All right, guys, welcome back to the Independent Investor Channel. I'm going to talk about 6 ways that you can prepare for a recession, okay? Listen, everybody is talking about a 2020 recession. This conversation's been going on for the last few years. I've been monitoring it quite closely on YouTube, just kind of monitoring the landscape. Anytime we get a hiccup in the stock market, everybody wants to come out and talk about doom and gloom. They want to talk about the meltdown. I don't even know what that means, okay? But these are some of the terms that I hear when it's referenced that a recession is looming and on the horizon. As an investor, as a disciplined investor, there are things that you can absolutely do to help you, okay? Now, these are tried and true things that you can do. Some of the things we're not going to talk about is trying to time the market, trying to tentatively pull back on stock, trying to strategically sell stock in anticipation of a looming recession. This video is not going to talk about anything like that, okay? I've been one of those folks that have been actually preparing for the last couple years, and I'm going to give you some insight on some of those things that I've done over the last couple years. And I always say, if you're going to invest to win in an up market or a down market, all right? And you guys are going to find that that is a theme of mine when you're looking to get into the stock market and define a program that's going to make sense for you. And I think a lot of people really gravitate toward this idea, all right? So let's kind of jump right into it, guys. I'm going to run through this rapid fire. These are 6 things that you can do to prepare for a looming recession. Okay, guys, number 1 is to evaluate your exposure. It's the times like these when the market is seemingly range bound a little bit, okay? You've got a little bit of time to breathe, kind of evaluate if you've been in the market for the last year or you've been in for the last 10 years. You can take a pause and you can monitor what it is that's happened in your exposure time. How has the account grown? Has it remained stagnant? Could you have done some things to build up that account over the time? Have you dollar cost averaged that account? How has it performed for you? You really want to evaluate your exposure limit. Look, guys, if you're young and you've got $10,000 and you've got $10,000 tied up in the stock market, no problem. You're young enough to where you can let that ride. There's no recession in 1 month or 6 months or next year that's going to cripple you unless you panic yourself out of the market, all right? But when I talk about evaluating exposure, if you're a little bit later in life, and maybe we're talking about 6 figures of assets in your account, 500,000 or above, maybe you want to stay true on that program, but it may not be as critical for you to continually overfunding the account. I talk about it all the time. I always encourage people that if you've got your foot on the accelerator right now, or you're in 6th gear investing into this market, maybe you can throttle back a little bit. It gives you that opportunity to take a pause and say, you know what? I'm sitting on 500,000 or I'm sitting on 125,000, whatever it is, all right? The numbers really don't matter as much as the fundamental approach, okay? So you can take this and relatively apply it to whatever situation you have. But look at it this way. If you've got that 125,000, for example, in the market, and you're looking to evaluate your exposure, and you have $500 in your savings account, perhaps maybe it's time to start throttling back on the investments and start putting some money aside. That's evaluating your exposure. Now, if you're satisfied with your level of exposure and you have an aggressive tolerance, you just have to make sure that if we do have that looming recession that everybody's talking about, that you're prepared to deal with it, that you can deal with that level of deep swing, all right? If you go into a 40 or 50% downswing in your portfolio, are you going to be able to weather that storm, okay? So number 1 is evaluate your exposure. It's one of the most important things you can always do. The stock market is not something that you need to hang your coattail on, win, lose, or draw, and die by the direction of the stock market. It doesn't have to be that way. It can be something that you participate in and grow wealth in, but you do it responsibly, all right? Number two is to absolutely build cash. This is what I'm talking about. This is something that I've done for years. I disclose to you guys my cash balance, and I'm always continually looking for ways to build that cash. I never ever, now I have been proven wrong over the last few years of really aggressively building cash. I've been more aggressive on building cash than I have been building my portfolio. No doubt about it. Portfolio, I've been really aggressive about taking profits where profits are there, staying long on my program, keeping the dividend reinvestment program going, and investing my annual contributions to the Roths. Okay, that's what I've been doing. That's what any responsible investor is charged with doing, and that's what I've been doing. But I haven't really been in any hurry to just throw money at this stock market, because the stock market's not telling me we're in that type of phase. Okay, that doesn't mean I'm not investing. It just means that I keep it within reason, and I'm more aggressive now on building cash than I've ever been. Now, if we enter into a bear market and into a prolonged recession, it'll give me that opportunity to flip my philosophy when everybody else seemingly does not take on that philosophy. There's so many people right now that are buying this market aggressively. I'm not. There's no reason to do that. Why? Because the market's not telling me that the time is indicative to do that. That's just what it's telling me. Now, I could be completely wrong. The market could run up for the next 5 years, 20% a year. It could do that, certainly. Nobody knows what it's going to do. But I'll take an educated bet that building cash and allowing my existing investments that I've got in the account to stay true and hold on their ways. All right. Number three, if we do enter into somewhat of a higher volatility time and maybe enter into somewhat of a recession, that's typically not the time where you want to be paying attention to your goals. I want to see you guys review your goals now, okay? You can make decisions, the best decisions that you can make. And when you set those decisions in motion in the stock market, there's no guarantee that your desired outcome is going to be reached. Okay, there's no guarantee. We set ourselves up to make the best decisions that we can possibly can, okay? We diversify, we dollar cost average, we acknowledge fees in the account. With all those things aligned for you, it still does not guarantee success in the market. But here's the thing, those things aren't going anywhere. And it absolutely is in your best interest to review those strategic goals that you set up for yourself. It will set you up so nicely when this looming recession starts or the volatility kicks up and everybody's talking about doom and gloom. Here's the meltdown. And you're sitting there, look, I'm still diversified. My share base has not changed. Yes, my account value has gone down a little bit, but is this really the time when I want to be making decisions within my portfolio? All right. You're looking to justify a decision in such a short amount of time. It just doesn't make any sense. When investing, your strategic goal was to invest and keep it in there long. And you're looking at it in such a short amount of time, whether it be 6 months or a year or even 2 years. I don't know. If we go into a prolonged recession, you might be stuck against that, and you might have to persevere through those times by reviewing your program, okay? But all things shall pass, and then we'll be coming out on the other end talking about how we can take advantage of a particular downturn, all right? So I want to review those goals. Number 4 is to stop buying and prepare to lock down your account, all right? It goes along with the philosophy of stop aggressively investing so tough, okay? There might be other things that you can do. There's other assets that you can buy, put some money to cash, reduce some debt, do some home improvements, do some other things other than your portfolio. The portfolio is not going anywhere. But when I say to put the account on lockdown, it's your ability to put the lock on the door, put those shares on moratorium, and live to fight another day. Don't give yourself that temptation to go in there and look at those accounts and tempt yourself out of selling those and saving the remaining money that's in there, right? It may go to zero, all right? These are all rationalizations, and we can talk until we're blue in the face, and there's still going to be people that succumb to the pressure when we do enter into a recession, if we do enter into a recession. All right, so it's a strategy that I'll deploy. All right, if we enter into volatile times, I won't look at it. Why? I have other things better to do with my time. I've done everything that I can do to put that strategic plan in place. Lock it down, all right? Take some faith in your program, okay? It's unfair to yourself to accept your program only when the stock market is going up, okay? But it's very hypocritical to say that you can't accept your program when the market goes down, okay? Number 5 is to prepare mentally now. I do my very best to tell you that when a recession hits and volatility kicks up, you are going to have every underlying potential stressor to the market come right to the forefront. The media is going to exacerbate. Consumers are going to stop buying. Manufacturing will slow down. Companies will be hit on the bottom line because consumers are stopping and buying. And it is a vicious circle for quite some time. Real estate may be affected, okay? Lots of systemic things will jump on board, and it will be a piling on effect, okay? Because we've gone from a euphoric stage to now proceeding toward our panic stage of a recession, okay? So going from one extreme to the other is something that a lot of people can't stomach. And the reason why is because it's so quick and it's so jarring, and the extremes are so spread apart, okay? But you want to prepare mentally now, and I'll tell you, there's nothing easy about going through a recession. I've been through them before in my career. It's not fun, all right? But prepare now. Ask yourself, give yourself the half-life stress test. Is your portfolio in a place, if you're sitting on $10,000 and you're a young couple out there, could you see your account go to $6,000? Okay. Now, I hate to pose scary questions like that for you guys, but this is the stock market. All right. And this is why we prepare you as best as we can psychologically and physically to own the very best assets in the very best account, so we can enter into these foreseeable future events, potentially a bear market or a recession, and you're mentally prepared to go into them. If we haven't done what it is that we strike out to do in empowering individual investors, then we're not doing any good. If you inevitably cannot handle the swings of a bear market / recession, you should not invest. You should not invest, because you cannot have it both ways. You cannot expect the market to just continually feed you profits when the market's all good, and then you want to complain when the market is down. And I guarantee it, this will be too much for a lot of people to take. It will be too much. And they will come to me and they'll want to blame everybody else. They'll want to blame me. They'll want to blame you two. They want to blame their mom and dad. They want to blame their pets for getting them involved in the stock market, when in fact the only one that is responsible for the decisions that you make financially is you, okay? Now, you're responsible for all the successes that you have in the stock market. I'm a fair guy. But there's two sides of every coin, guys, okay? And I hate to be the bearer of bad news. It's not really bad news. It's just reality, okay? And you have to be mentally prepared to understand the ins and outs about what is possible, not only in the positive side, but also on the negative side of the house, at least for the short term, all right? Now, the last thing in preparation for a recession, and I'll be the only one on YouTube to offer this little tidbit. You would have had to have stayed with me for 15 minutes into this video to hear this. But for those folks out there that are looking for that strategic advantage in a managed account, Let me tell you what, guys, in a recession, those folks are still paying those management fees. They are still paying those dividend reinvestment fees. They are still paying all of the fees that come with a managed situation. I want you guys to remember the strategic advantage by being a self-directed investor. The self-directed advantage is so incredible that your portfolio, yes, though it may be subject to a recession, you will have a strategic advantage over every single one of those other portfolios if you can just stand the test of time and look for a better day. Because those folks right there, they pay that fee in an up market and they pay that fee in a down market. And I tell you what, there's no better way to add insult to injury by paying a fee to a financial planner who's managing your account in a down market. You want to talk about pissed? That's one way to get you there. All right, guys, thank you so much for tuning in. Seemingly everybody's talking about a recession is right around the corner. I really don't see any of the indicators that would push us in that direction, but I'm prepared tomorrow. I'm prepared tomorrow. I'm prepared 6 months from now. I'm prepared 5 years from now if it happens to be then. To be quite honest with you guys, I really don't care, and neither should you. You should prepare your portfolio to win in an up market or a down market. That is the secret sauce of investing, all right? Don't listen to everybody out there talking about doom and gloom. You've got a bubble over here, you've got doom and gloom over here, you've got this and that and everything else, guys. It doesn't do you any good. The only person that you need to focus on is you. Guys, if you appreciate the message, hit the subscribe button, the notification bell. Leave your comments about a looming recession in the comments below. I'll enjoy reviewing those. Share the message with anybody out there that's starting in the investment community, man, and you're fragile when you start. You don't have the type of real forged in fire type of approach that I do. And sometimes hearing a message like mine can really help prepare you mentally for what everybody's talking about as a looming 2020 recession right around the corner, guys. Thank you so much for tuning into the video, and good luck in your investment future.